I need my glasses.
I told Tim we had to put our jackets on today because we're going to talk about money. So we got all dressed up and we're going to do a video here about investing in real estate. And I guess we have to say before we get started, we might not have to, but I feel like we should say we're not what do we call it? Financial advisors. We don't play one on TV. Check with the appropriate consultants before making any financial decisions. Is that legal, Tim?
Yeah, sounds good to me, man.
All right, great.
From our experience.
So we don't have any courses to sell you. We're not trying to, sell you any investment strategies or anything. Honestly, Tim and I were just talking, and he was trying to tell me to buy a house, and I was like, you know what? We should talk about this on our podcast.
Yep.
So, Tim, what you got going on, man? What's your advice? What's your strategies? What do you want to talk about?
Well, here's the thing, Brian. It's kind of wild. We're talking to everybody, and everybody's talking about, well, I might rent, I might buy. People realize there are no rentals on the market, Brian.
Right.
And what rent? I mean, literally, that the number of houses available for rent, now houses, right, versus apartments, it has diminished so dramatically. And I'm bringing that up because people really don't want to so much rent an apartment. They really prefer a house. Okay. Number one, pets. You and I both know how many rentals will even take a pet, right? Or how many apartments will take a pet, for that matter.
I tell people all the time, number one rule, if you want to ask me, hey, I want to rent my house, what's your advice? Number one rule, no pets, not a fish, not a pet ant farm, nothing, under any circumstances, no pets.
And people don't realize, and when they do have pets, they want a pet deposit, they want additional pet rent. It is pretty insane. So we began to kind of evolve this conversation of, okay, you know what? What does that tell us? There is a huge need for single family townhouse rental properties. That's what it comes down to, right?
Okay.
And then people are collecting a premium. And let's face it, what are we talking about here? Passive income. That's really what we're talking about. So it comes down to, okay, you know what? We all want to kind of get ahead in this world. We all want to kind of find ways to create more rental income or more passive income, and get a better investment. My stock market portfolio is going up and it's going down. Brian, you and I used to joke, our 401k became a 201k, right? It's like you just can't predict shit anymore. Oh, should have said that. Well, scrap that.
You're fine, man. You're fine. We're on the internet. We can say whatever we want.
All right, what the heck? So on real estate, the beautiful thing is we're paying principal down, right? We're collecting passive income. We got a lot of tax benefits, and there's a massive demand for housing. Now, Brian, you and I kicked in the other day, and we talked about this. There's also some opportunity when it comes to assumptions, right?
Yeah.
And we talked about, we had a townhouse that we were discussing that was over in Montgomery County.
Yep.
And that had an assumable mortgage.
Yes.
Break out exactly again what that house had and then how we were presenting it from a perspective.
So the house is only 1 year into the mortgage. And
so 29 years left on the term, right?
Yeah, so she has a 3.25% interest rate, and she has a delta between what she owes and the list price, which will essentially cover just the transaction, which would be the realtor fees and the closing costs. And that's it. So
and how much was that, Brian? Just number wise.
So it's about $30,000, $40,000. But by the time you pay the closing costs and everything, it's closer to $50,000 because Montgomery County is expensive. And so essentially what somebody needs to do is just come up with the delta between, say 460 to 500 and then pay the closing costs or whatever. And then in that particular situation, they will take over the mortgage at 3.25%, which is the equivalent of a $350,000 house, and the list price is $500,000. Again, those are rough numbers, but the idea is, your payment is the equivalent of buying a $350,000 house.
And what's the payment, Brian?
At this moment, it's $2,755.
Okay, so freeze up there, $2,755. A client's going to need $50,000, let's say, to get into the property, right?
Yes. Yep.
They're going to assume the existing mortgage
Yep.
They're going to assume the balance of the term.
Correct.
It's got to be done as a primary residence. So keep that in mind, right? We've got to buy it as a primary.
Yep.
But at the end of 12 months, if they change their mind, they want to turn it into a rental, right? What would the potential rental income be for that neighborhood?
Estimated about $3,200 a month.
So here we could assume a property. We could, in essence, get a great rate, jump on into the term, get a little bit of amortization out the door, and then they're going to make $6,000 on top of somebody paying the principal, right?
But they're buying as a primary residence. That's tricky.
Right. Well, I'm looking at 12 months from now after they buy the house.
Okay. Yes. $500 a month passive income.
You could also put your kids in there. Let's face it. They could, you could co-sign. They could be a primary residence for them. But so back to the story. So we get into the house. We're paying. How much are you paying in principal curtailment in essence?
I mean, you figure what, $700 a month probably.
Based on the mortgage, probably a little less. Let's make it 500. Just
yeah. 27.55, and you're getting 500 out of it. How about that, ladies and gentlemen?
$500 going to principal, $500 in additional profit. So now we've made $1,000 a month. That's $12,000. And let's face it, they could always house hack, rent bedrooms out as well. I mean, that's the other. We always talk about different ways of investing. We look at it as, okay, not only just a regular investment, not only the idea of house hacking or renting out rooms, but then we also have vacation rentals, right?
Yeah. So you're talking about, you're saying, when you say house hacking, just to explain, you're referring to renting out all the rooms individually. So the upside to that is you can get more money. The downside is you now have to deal with 4 or 5 separate tenants and leases and payment plans.
I would live in the house and then rent to other 3. How many bedrooms and baths was this house?
It's actually 4 or 5 bedrooms. Yeah.
Okay. And was the basement finished or unfinished?
It's got an apartment in the basement, but there's no external exit. So you have to climb through the stairs on the inside to get out. So it's not really, can't really make that. It's an apartment, but it's not legal because there's no entrance. Like, you have to climb up the stairs to get out. There's no way out of the basement. If there was a fire, it's just a terrible situation. So if it was my house, I would build stairs to get to the outside, but then you have to do permits in Montgomery County, which, I don't know.
So could you live in the basement and rent out the 4 bedrooms?
Yeah, you could, as long as there's no fire. Yeah.
Okay. So
get a couple fire extinguishers.
All right. So back to the story. We've got an assumable loan, great rate, great payment, $2,700, right? We got potential rental down the road a year from now, $3,200, $500. If we're going to be able to collect rent of $500, it's not house hacking, that's not vacation rentals. Another $500 principal. We're making $1,000 a month. That's $12,000, and that's on your $50,000 investment. Do you agree?
Yep. Yes.
Okay, I'm bringing out my trusty little calculator here, and that is a 24% return plus tax benefits. Now, Brian.
Yeah, and that's key. That's huge, by the way. Plus tax benefits. You're writing off the interest, which is a ton. It's more than 500. Hello.
So here we look at it from a different perspective. A lot of people think about investments. I need 20% down. I got to have, X, Y, and Z. And here we're taking it from a different approach of every house you buy, whether it's a primary residence, an investment, a second home, it's always an investment in essence, isn't it?
Yeah.
And with that being the case, you've got to use the existing tools in your tool bag to be able to acquire the properties and start. I mean, this would be a great house for somebody in their 20s.
Going to your tool bag. So one strategy is buying an assumable loan, and you have to have it as your primary residence. The way to do that is really to find a realtor who can find you all the assumable properties.
Right.
And I think that, when you're buying investment property, right, it's normally a minimum 20% down.
You can do as low as 15, but it's a little tricky.
Yeah. So let's just say ballpark it at 20% down. So that's $100,000 on a $400,000 house.
Right.
25% down would give or take whatever's 85,000 or something like that. So plus closing costs, you'd be in over 100. In this particular situation, you're at about half that. So
in great return, minimum investment, right?
Mm-hmm.
great rate on the payment. I don't think you ever refinance that, Brian. I mean, I'm just
Right.
saying.
So that's kind of the other advantage there is you're taking on a 3.25% rate, which where in a similar situation, if you bought this house straight up off the streets, investment property, 20% down, you're looking more like 6.5%. Your payment is not 2,700. It's more like 3,700 or even more than that. Yeah, it's brutal, right? And then now there's no way to rent that to make money. So
Right.
that's one way to do it as an assumable loan. The downside there is you'd have to live in it as your at least for the first year. So
Correct.
let's talk about another strategy, Tim. What would be another way to make passive income with investment property?
So a lot of people, we talked earlier about your 401k, right? Well, why do you invest your 401k in stocks? Why do you have it in a savings account? Why not take that 401k and do a self-directed retirement plan, right? And take that money now and take that and buy an investment property and have that rental income go directly into your retirement plan. You're deferring the taxes, or if it's a Roth, right? You're able to, if it's a Roth, that's a home run. You're able to go ahead and really reap the profits and never pay taxes on it again, which is phenomenal. Okay. So you can pocket into a Roth or pocket into a regular IRA.
All right, let's say that most people are going to have a 401k. So let's talk about a strategy to use a 401k. And again, this is your forte here. Go over the numbers because you'd be paying a payment to pay back your 401k as well as a payment on the home itself.
Right. Well, no, and that's the point. You're not paying the 401k. You're not borrowing on the 401k. You're doing a self-directed IRA. And so that means you have funds available in an IRA. Let's say you move from
But I thought it was a 401k. Do we have to move it to an IRA?
It's got to be a self-directed IRA, right? And so you take that self-directed IRA funds and you invest it in your properties, right?
Let's time out for a second because I'm lost. I'm gonna pretend that I'm have no idea what you're talking about, which I don't. Right. So can you not use your 401k?
No, you can use your 401k only to borrow against or take a hardship withdrawal.
Okay, so that would probably not be wise because of the financial implications. Like you won't be able to borrow it at 1% interest.
Yeah, your interest rate is going to be a little higher on a borrowing factor, and we really don't want to have to incur additional payments.
Exactly. So that would not work. So you're talking about using an IRA, and
correct.
And with the IRA, there's a maximum that you can put in there every year. Is that correct?
Yeah, that's correct. But let's freeze here, Brian. So a lot of clients have switched jobs. Every time you switch your job, you have money that you've put into a 401k with your business or however the case may be, and you have a choice. You can roll that money into the new company's 401k, or you can roll it into a separate IRA. Right?
Okay. All right. So let's just start the conversation back. Let's start over. Instead of saying 401k, let's just say, okay, we have an IRA. How do we buy houses if we have either a regular IRA or a Roth IRA?
So there's a way to set it up. And I have a gentleman that I can refer you to later on who sets these things up. And you've got to set it up in such a way that allows you to be self-directed.
Okay.
And then you've got to separate your funds out. And then you can use those funds to acquire real estate and collect that passive income through your retirement plan. That's
all right. So let's give me an example. Let's use real numbers. Like let's say I got 350 grand in my IRA right now. What do I do?
Very good. Okay, so I have a client who right now, and a really good illustration, they've got about $300,000 right now, and they've moved their funds. They left their old company, moved and put it into a self-directed IRA. I've got a gentleman by the name of Jeremy who sets these things up. It runs about $2,000 to set up. Jeremy sets it up. You set up a separate bank account, whole 9 yards. And then with those funds, you can now use those funds to acquire properties, putting 20% down.
Okay, so let's just say, for instance, we buy a $400,000 house.
Sure. So you're going to need about $100,000.
Yep.
Okay. 20% down is 80 grand. Another $20,000 for closing costs. Okay. Yep. And literally, you buy the house, you acquire it, you turn it into rental, and then those rent payments, in essence, they go to satisfy the mortgage, right?
Yep.
Okay. To satisfy the payment being dealt with, and then the balance is the profit, and that profit is either deferred because it's a regular IRA or if it's a self-directed IRA as a Roth. Okay, a little difference there. So the Roth IRA, in essence, is you've already paid the taxes on the funds. You don't have to pay taxes in the future. And keep in mind, we're giving you the very simplistic standpoint. We want to make sure that we don't talk to a financial planner.
Yeah, we said that in the beginning. We're good. I say it again. We don't play when we're not financial planners. Don't take our advice. Talk to the appropriate consultant.
Well, what a great way of doing it, Brian. I mean, think about it. I mean, here I'm using my self-directed IRA to do this. You're right. You can borrow on your IRA to do it as well. We've also got clients who borrow on their home equity line. And they'll take that funds to make their investments. And then what they'll do is they'll buy the investment. Sometimes it needs some tender loving care, it needs some work, right? And then they'll refinance, out of that house, out of that mortgage in about 12 months. And a lot of times they're able to, let's call it, do a cash out and collect their soldiers back. The soldiers are the dollars, right?
Yes. What you're referring to is you buy a house.
Yeah.
Let's say, for instance, you buy a house that needs a little TLC at $200,000 and you put 20% down, which is $40,000. And then let's just say, your down payment, like your equity position is, you now have
160.
You have 20,000, 40,000 out of your pocket that you had to borrow from your house.
Correct.
And let's say that you had to put 20,000 into it in order to rehab it, right? So you now have $60,000 of your money into this piece of property. However, after you rehabbed it, it's now worth $300,000 instead of $200,000. So now you can cash out refi up to 80%.
Now 75% on rent on investment.
All right, 75% of 300,000 is
225.
225.
Right. I owe 160.
Okay, so you can cash out 225, and I'm trying to think, at that point you just got back 45 of your 60,000 investment, right?
No, actually, 225 minus 160 is going to give you $65,000,
which is what you have into it. You put in 60,000, so now you got all your money back. Now you have $0,
and you're making rental income.
So now your new principal mortgage is 265. Is that what you said?
No, 225 is your new mortgage.
225 is your new mortgage. Your house is worth 300,000. You have no money invested in it, and now you have a rental property with passive income, assuming that the income from your $300,000 house covers a 225 mortgage, and that's where you need to make sure you're good at math and you understand how to, calculate rent versus whatever. And there's also a number, and Tim, maybe you want to talk about this real quick. Isn't there a number you want to use that's a mathematical equation that says rent times mortgage plus repairs plus this factor 0.0567 divided by 4 tells you, and as long as the number is 3 or higher, that you buy the house?
I've never heard of that, but it sounds really good. Next week. That sounds good. I like that.
I talked to a real estate investor, and he's like, Brian, you got to understand the rule of 12. So I was like, all right, what's that? He said, well, you take the rent and you divide it by 12 and you multiply it by the amount of payments you have, and then you 0.065, and then you divide the mortgage into it. And if your number is over 1.5, then that's where you need to be. I was like, oh, sweet.
So there's a couple of factors in there that he's making it a very simplistic return. You want to make sure that you're looking at, what does my equity go look like after I buy the house and do whatever work needs to be done?
What he was calculating was there's a factor that says maybe I don't rent it 12 months of the year, maybe it's 11, and there's a factor that says over the course of the life of this house, there's a number of repairs you're going to need to make, and then there's a factor that says you might need to pay a property manager. And then there is and then there's an appreciation factor that says how much it'll be worth. And then there is whatever. So somewhere in there, it only makes sense to buy it if you're profiting at this percentage. Do you have that?
I don't have it, but I don't fully agree with that calculation.
Okay.
So I think that's in my opinion, that's a very narrow way of looking at real estate, because I think you got to look at it from appreciation standpoint. You've got to look at it as the net return. You've got to look at it as the long-term potential. You've got to look at the tax benefits. If you're a property manager, there's multiple parts to the equation. And then you got to decide how am I financing it? Is it the IRA, et cetera. You know what I mean? Like,
so my advice is to call Tim, because that's the situation where it's like a lot of people get in their head, I'm going to buy investment property. All I need is $100,000. I have $100,000. I'm going to buy this house. The mortgage is going to be $2,500. I can rent it for $2,800. I'm going to make $300 a month. It's a great deal. Not necessarily.
Not all. Yeah, not all.
Okay, because let's just run this one through. You buy this house, you put it on the market. It doesn't rent the first month. You just paid a $3,000 mortgage. All your profits out the window. Now you're going to break even. I know we have the tax incentives, and I know we have appreciation, but we also have the situation where somebody could damage your house, and there is a cost over time factor of replacing the roof, the windows, the flooring, the appliances. There's a number in there, right? And then that's where if you don't have money in the bank, if you're not financially independent, you can get caught. And this is where I think people that don't know the formulas get in trouble, because they just assume, hey, I'm making $300 a month. It's a great deal. I talk to people every day who was like, oh, I just rented my house. I'm making $300 a month. It's like, well, that sounds good, but that's really only $3,600 a year. Do you know what kind of risk you've now taken on for $3,600 a year?
And a lot of times, though, it's worth it.
It is. But that's where I feel like you need to talk to an expert. And you should not make these types of decisions without talking to your accountant, specifically someone like Tim, who understands all the different numbers you're calculating. Because most people are looking at the one number. How much am I profiting after my mortgage is paid? And they're not looking at all the other numbers. One of the benefits is appreciation of the house. House prices go up over time. So even if you are breaking even and you have enough money to cover the expenses, you're still winning because your house is worth more money over time. The other factor that, people don't necessarily take into an account for is the interest write-offs. So when you own an investment property, let's say your mortgage is $3,000 a month and $1,000 of that is going towards taxes, Tim. Towards interest. What is do you get the same tax benefit as you do on your primary residence?
No, because what you're looking at is the rental income coming in, right? Gross income, and then you're subtracting out your expenses plus depreciation. But keep in mind, remember, you had to buy that new Ford F-150, right? To service your rental properties. You know what? You decided to go to the Bahamas and look at Sam's house that he's going to have to sell. Remember the crypto king, right? He's going to sell his house. And you're taking a trip to the Bahamas to do a tour of the house. You got to write off that trip, Brian. Come on, man. I mean, there are multiple options available now. It's funny. You need to have cell phones for you and your family, right, in order to be able to communicate on your investment properties.
But so you're saying that, and I'm trying to pick up what you're laying down here. You're saying that all of the expenses tied to maintaining that property become tax write-offs. You essentially become more. What's the word we use to say able to write off more of things in your life that you wouldn't normally be able to write off?
I think it's called being tax savvy.
Tax savvy.
There you go. Right? Like the word, man. Like the concept. So, and we haven't bridged the last concept.
Okay.
Vacation rentals.
This one, I think, is if this was me personally, if I had to pick one way to invest, Airbnb all day long. House hacking versus buying like a residential versus a multifamily versus what other types there are. I would say Airbnb would be my very first choice because it is so absolutely lucrative. And I mean, I know people that have, properties are making over $100,000 a year on.
Now you just heard it. You heard what Brian said, right? I mean, here, right? That's my point. So you have options, Brian, and people don't conceptually realize. And here's the thing: it's not as hard as it sounds, right? You've got to, get as much information possible. In fact, I got a class coming up on vacation rentals in a few weeks. I would take a class. Talk to somebody who's doing it, right? Get involved in the process. But there are so many opportunities from investment, and here's the beautiful thing about investment. Investment starts with your primary, right? So I'm gonna last thought process I'm gonna throw to you. One of my clients, he and his wife, he's 32, she's 31. They now own 7 properties. Each one was acquired as a primary residence. They lived in it for a year, 2 years, and they've moved up. Okay. And my point of the matter is they moved up, they rented, they did vacation rentals, etc. And my point is this is a guy and a girl who are right now have over $2.5 million in real estate, of which they owe about $1.5 million. That's mind-boggling. I only wish I started doing that when I was in my 20s.
I know a lady who did the same thing, except for she sold it every time, and she took the money and bought. And the true story, the last house she bought, she financed everything in cash. Waterfront,
Right.
paid $300,000 for the waterfront lot, paid cash to build a house, sold it for $1 million, and that was all profit. Went down to Florida and is living happily ever after. And what she did, she started with a little Rambler in Chesapeake Beach, and then she fixed it up and sold it and bought one in St. Leonard, fixed it up, bought one in Prince Frederick, fixed it up, like literally did it, I think, 5 times over the course of 10 years. You lived there for 2 years, so you can sell your primary residence, not have to pay capital gains. I'm not an accountant. I don't play one on TV. And then you can invest that money in a new house, fix it up, and 2 years later, reap the profits and continue to do that. In Tim's scenario, instead of selling it, you just rent it, and then you could buy a new one because it's a primary residence. You get access to, whatever loan programs give you some benefits for buying a primary residence. And then you can use the rental income from your existing property to offset the mortgage so that your debt to income ratio is not fully impacted by owning 7 houses. It's not 7 mortgages versus your income. It's 7 mortgages minus the rent at what? 75%?
75% of the rental income. Yeah.
So let's say, for instance, you got $10,000 in mortgages. I'm sorry, $10,000 in rent. You can use $7,500 of that as to offset your income. So essentially you have a $2,500 debt, even though you have all these mortgages. So I think that's also a fantastic idea, Tim. And that's something that doesn't require any savings of all this money. You theoretically take your primary residence, rent it out, buy a new one. You can buy one FHA, refinance it out into conventional and buy another one. Like, there's a lot of different options, that you can do. And selling your primary residence, taking the money and investing it in a fixer upper, and then living there for 2 years and then buying another one. It's a great idea. People think staying in your house for 30 years and paying it off is the way to go. It kind of is, if that's one way to do it. But if you're really trying to maximize profit, it's better to sell it every 2 years and buy a new one and continue to fix it up to be able to push forward. Is that what you would say?
You nailed it right down, man. As long as you can handle, that movement. Remember, every 2 years, your limit is $250 for an individual, and profit $500,000 for a married couple. Might be a good reason to get married, just to say,
Yeah. So there are tax implications there. You could only profit $500,000 as a married couple on the house but you pay capital gains on what's over and above that. And that's profit, by the way. That means that money that you made that wasn't already there, and you can subtract out the repairs you made. So if you've invested $100,000 fixing the house up and you can document it, doesn't that also offset the capital gains?
That does go into play. But remember, we would always recommend you talk to
an accountant, a CPA, a financial advisor, Tim Murphy. Yeah. But Tim, I think that a lot of great ideas there, especially ones that don't require, a ton of savviness. And my favorite one on the list, honestly, Airbnb, guys. I think you guys are, I think the biggest misconception about Airbnbs are they are for like Chesapeake Beach, little waterside towns that people are going to want to vacation in. That's not true. I know I talked to a lady who lives in La Plata. She rents out the basement of a Rambler in a neighborhood, and she has traveling nurses and people that are, on jobs for 6 months. They rent this thing out, or they come there for the weekend, or they're in town for a job interview and they just stay at this place. People would rather stay in an Airbnb than they would in a hotel for a similar cost. When I just traveled to Arizona, we stayed in an Airbnb 100 times nicer than a hotel because I could buy all the food for the week and just keep it in my refrigerator. And hotel, I'm stuck in this little box. I had a hot tub. I had horseshoe pits out back. We had a whole fenced in yard. We paid the exact same money as the guys that stayed in the hotel. And the people that owned the Airbnb were getting $300 a night times. And this thing was booked like all year round. I mean, think about it. 3 times 3, that's $6,000 a month, right?
That's 9,000. No, 3 times 3 is $9,000.
Yeah, $9,000 a month they're making on this property. And I guarantee it probably was this was in Arizona, but the market there, I kind of looked at it, was probably a $500,000 house, and they're making $9,000 a month. Do the math on that, guys. You own 10 of those and see how that works. The one thing you want to watch out for with Airbnbs are homeowners associations and incorporated areas that are going to have restrictions. Think about Baltimore. Everybody bought all those Airbnbs and they were like, never mind. And then they had to get rid of them. Same thing in Chesapeake Beach. I know people that bought a bunch of Airbnbs. They were like, never mind. And then the guy had to sell 4 of them. So yeah, that's the one thing you want to watch out for. I've seen people buy houses in planning on renting them. They contact the HOA. They're like, there is no rules against the Airbnb, but thanks for letting us know what you're going to do. We're meeting tomorrow. And our plan is to enact a ban on short-term rentals. Give me a couple weeks and you'll be definitely not renting your house. So that's just a word to the wise.
Brian, we covered a lot today, man.
Yeah.
And so much more.
Yeah.
So Brian, if they have questions about assumptions, or want, any kind of questions or ideas about the marketplace,
give you a call.
Give you a call. Come on, man.
Seriously. Yeah, I think you should call Tim first, to be honest with you, because you want to know what you're getting yourself into. And that's my best advice, Tim, and you can throw out any advice you have. My advice is talk to a lot of people and do your research, because I specialize in helping people's houses didn't sell. I talk to people all day who have rental properties that they can't sell, houses they thought they were going to flip that they can't sell. And it's because they were not taking advice from experts. And, you have to be very careful who you have in your circle. You want to make sure you can trust your people. So that's it. What do you think, Tim?
There you go, man. You're on it, brother. Let's get things rolling, man. Hey, phenomenal year coming up, man. I'm ready to kill it. You ready to kill it?
Yes, sir.
All right, man. All right, sir. I'll catch you later. See you next week.
All right, Tim.